So, starting right off with the latest price action, ARM is currently sitting at $271.43.
Yeah, which is, a pretty critical level right now.
It really is. I mean, it's down about 40% from its 52-week high of $452.70.
Right. A massive, massive haircut.
But the main catalyst here, and the thing that makes this so fascinating, is that fundamentally, they are executing flawlessly. Like, they boast a 97.54% gross margin.
Which is just almost unheard of.
Exactly. And they operate as the foundational compute platform for the entire AI era. So today we're figuring out what happens when a dominant company is priced, as if it can never make a single mistake.
Yeah, the tension between flawless fundamentals and a really unforgiving valuation.
Welcome to Market Pulse Daily. I'm your host, and today we're looking at ARM. But before we jump completely into the data, a quick reminder about StockOracle.
Right, our go-to tool.
Yeah, StockOracle is the AI-aided stock research platform that we use for, fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
It's super helpful for mapping out a complex situation like this one.
Definitely. And there's a special 14-day trial link below in the description. Just keep in mind, StockOracle is not financial advice. It's not a buyer or sell recommendation, a trading signal service, or real-time market data.
Right. You always have to do your own homework.
Exactly. AI insights and valuation estimates can be incomplete or wrong, and the data might be delayed, so always verify important facts. Also, that link in the description is an affiliate link, so the channel may earn a commission at no extra cost to you.
All right, so getting back to that 40% drop.
Yeah, let's look at the underlying business model first, because, to understand the drop, we have to understand their moat. ARM doesn't actually own those massive multi-billion-dollar fabrication plants, right?
No, they don't pour any silicon themselves.
Yeah.
Zero physical manufacturing.
Right. They operate an intellectual property licensing model. They basically write the foundational instruction sets, like the complex blueprints that tell a processor how to handle commands.
Exactly. It's an architecture firm.
Yeah. It's like an architecture firm that designs a skyscraper, sells the blueprint to a developer, and then, that's the crazy part, they collect a royalty on every single apartment rented in that building forever.
That analogy is perfect, honestly. And it explains why their trailing 12-month gross margin sits at that 97.54% figure you mentioned earlier.
Because their cost of goods sold is basically zero once the engineers finish the blueprint.
Right. Once the design is done, copying a digital blueprint costs nothing. And that translates beautifully to the bottom line, giving them a net margin of 20.25%.
Okay, but the reason the market pushed this stock up to $452 earlier this year wasn't just because of smartphones, right?
No, not at all. The entire growth narrative shifted to data center computing and artificial intelligence.
And the revenue numbers totally reflect that shift. Like looking at the data, in fiscal year 2024, ARM brought in $3.23 billion. Then by fiscal 2025, that jumped to $4.0 billion. And for fiscal year 2026, which ended in March, they hit $4.92 billion.
It's a remarkably consistent trajectory.
Yeah, and their net income almost tripled. It went from $306 million in fiscal 24 up to $904 million in fiscal 26.
Which is phenomenal growth for a company of that size.
And it's continuing. Even in their recent Q1 fiscal 2027 results from late July, they posted $1.29 billion in revenue and $270 million in net income just for that quarter.
So the mechanism driving that growth isn't just that they're selling more chips, it's a structural shift in their licensing.
What do you mean by that?
Well, with their newer V9 architecture, they're actually capturing much higher royalty rates per chip. And in the data center space, power efficiency is everything right now.
Oh, because AI takes so much electricity.
Exactly. You have these massive server farms packed with thousands of power-hungry GPUs training large language models. The CPUs that feed data into those GPUs have to run as cool and efficiently as possible, or the whole system overheats.
And that's where ARM's design comes in.
Right. ARM uses a RISC-based instruction set reduced instruction set computer, which is just inherently more power efficient than the traditional by 86 architecture we see from Intel or AMD.
So they have a massive technical advantage in the data center right now.
Yeah, and that's why BofA Securities recently projected that AI agents are going to drive server CPU demand to $210 billion by 2030.
Wow. $210 billion.
Yeah, and ARM is perfectly positioned to capture a huge slice of that.
And they're not just sitting still either. They just spent $265 million in July to acquire Dream Big Semiconductor.
Right, which was a very strategic move.
Yeah, it signals they are moving beyond just CPU cores, right? because Dream Big specializes in smart NIs and chiplet interconnects.
Exactly. ARM realizes that the future AI data center isn't just one giant processor. It's a bunch of specialized chiplets all stitched together.
So they want to own the connecting tissue, not just the brains.
Right. And they absolutely have the cash to do it. Their operating cash flow for fiscal 2026 was $1.52 billion.
Wait, so this is actual tangible cash hitting their bank account right now, not just forward-looking AI hype.
No, it's real. They have over $2.7 billion in cash and cash equivalents on the balance sheet. Cloud providers are actively designing custom silicon right now using ARM's architecture, and they're paying for it.
Okay, so this brings us right to the tension of this whole analysis. If the architecture is that essential and the cash flow is real and accelerating, why did the stock collapse from $452 down to the low 270s?
Yeah, it's the $271 question.
Right. To understand it, we have to look at the valuation multiples.
Yeah.
ARM is currently trading at a trailing 12-month PE ratio of 278.12.
Which is just staggering.
It is. And a price to sales of 56.31 plus a price to book of 33.65. Those aren't just growth multiples. Those are like priced for absolute perfection multiples.
When you buy a stock at 56 times its top-line revenue, you are leaving zero room for error. You're stripping away every ounce of your margin of safety.
It's like buying a front-row concert ticket from a scalper for 10 times the face value.
Huh.
Like, the concert will probably be amazing, but is it mathematically possible to actually get your money's worth at that price?
That's exactly it. Institutional investors who model out cash flows at a 278 PE have to assume that ARM will conquer the data center market without facing any pricing pressure or any cyclical downturns for the next decade.
Which is impossible to guarantee.
Right. If growth decelerates by even a tiny fraction, maybe smartphone upgrades slow down or data centers delay their build-outs, the math behind a 278 multiple just shatters.
And we can see how fragile it is when we look at the beta, right? ARM's beta is currently 3.92.
Yeah, meaning it's highly volatile.
It's moving almost 4 times as aggressively as the broader market. And the moving averages tell a really clear story about this volatility.
The technicals are pretty split.
Yeah, it's in a near-term pullback, trading below its 50-day simple moving average of $308. But it's still sitting above its 200-day SMA of $195.
Which is why we see this tug of war. The stock is up about 95% over the last 52 weeks, despite just taking a 40% hit.
That tension between the 50-day and the 200-day averages usually triggers a lot of algorithmic trading, right?
Oh, absolutely. When a high beta stock breaks below that 50-day average, momentum algorithms instantly start unwinding positions to lock in their profits, and that just accelerates the drop.
But the long-term buyers, the ones eyeing that $210 billion server market, are probably just waiting to see if it tests the 200-day average before they buy back in.
Exactly. But they aren't just waiting on charts. There are some massive fundamental storm clouds gathering that could actually permanently alter ARM's earning power.
Right, because we have to ask who is actually paying these 97.5% gross margins. Companies generally hate handing over that much margin if they can find a loophole.
Nobody likes paying the toll.
And that leads us straight into the Qualcomm litigation trial, which is set for Q4 of 2026. This is a huge deal. It's not just a standard patent dispute.
No, it attacks the core of how ARM makes its money.
Right. So Qualcomm is historically one of ARM's largest customers. But the dispute is over Qualcomm's acquisition of a startup called Nuvia.
Yeah, Nuvia had a very specific type of ARM license, an architecture license agreement.
What does that mean exactly?
It meant Nuvia was allowed to design custom CPU cores from scratch using the basic ARM instruction set instead of buying ARM's expensive pre-designed cores off the shelf.
Ah, okay. So Qualcomm bought Nuvia and basically tried to use Nuvia's custom designs in their own massive product lineup.
Exactly. Qualcomm wanted to use that cheaper license to bypass ARM's premium fees and challenge Apple's chips in the PC market. But ARM is arguing that those licenses are non-transferable. Like, you can't just buy a smaller company that has a great deal and apply it to your giant global supply chain without renegotiating.
Right. ARM actually revoked the Nuvia license and is literally demanding that Qualcomm destroy the designs Nuvia created.
The financial stakes there are wild. If ARM loses this trial, it sets a precedent that major customers can just buy up smaller licensees to dodge the premium royalties.
It would fundamentally erode their pricing power. I mean, what's to stop NVIDIA or MediaTek from doing the exact same thing?
And then that 97.5% gross margin suddenly faces intense downward pressure.
Exactly. It creates a massive overhang on the stock. You have a company trading at almost 280 times earnings, but the actual mechanism driving those earnings could be kneecapped by a judge in Q4.
Institutional capital hates that kind of binary legal risk.
It makes projecting future cash flows pretty much impossible. And we are definitely seeing that hesitation inside the company itself. Looking at the insider trading data from May through August of 2026, there were 12 open market sell transactions by insiders.
Totaling over 80,000 shares, right?
Yeah, and the open market purchase ratio is 0. There hasn't been a single insider buy during this whole 40% crash.
Now, to be fair, insider selling is a nuanced metric. Executives get paid in stock, so they sell to pay taxes, or buy houses, or just diversify.
Right, but the lack of buying is what's alarming.
Exactly. When a stock falls from 452 down to 271, if the executives truly believed the market was mispricing their growth, you would usually see them buying up shares to signal confidence.
But they aren't.
No. The total lack of buying suggests the insiders might actually think the $270 range is a fair valuation, especially with the Qualcomm trial hanging over them.
Wow. And there's another threat on the horizon, a supply threat. SoftBank took ARM public, but they still own a massive majority stake in the company.
Yeah, they control the float.
And there are speculative rumors going around about a potential SoftBank secondary offering.
Which makes a lot of logical sense. SoftBank's Vision Fund invests heavily all across the AI ecosystem. If they need capital for other AI startups, or if they just want to lock in some profits after the stock ran up 95%, they could sell millions of shares.
And a secondary offering from a majority shareholder is just basic supply and demand disruption.
It creates huge share supply pressure. If an institutional fund wants to take a $100 million position today, they have to worry that SoftBank might dump a massive block of shares next month at a discount.
Which would instantly dilute the value. So we've got an incredibly complex setup here, an undeniably dominant business riding the biggest wave in computing, but it's fighting a 278 PE, a beta near 4, an existential lawsuit, and dilution risks.
It's a perfect storm.
Which is why the data points to a perfectly neutral overall assessment. It's a total standoff between growth and risk. So let's look at the catalyst calendar. What events will actually break this stalemate?
The first major checkpoint to watch is the Q2 fiscal 2027 earnings report on November 4th, 2026.
Okay, what are we looking for there?
The market is going to forensically analyze their royalty recognition. ARM's licensing has a one-quarter lag in reporting, so we need to see if weakness in the smartphone market is dragging down revenue.
Or if the AI data center deployments are strong enough to offset it.
Exactly. At these multiples, any downward revision in their forward guidance will just be brutally punished.
Right, and the second massive catalyst is obviously the conclusion of the Qualcomm trial in Q4.
That's the binary event. If ARM gets a favorable ruling, meaning the court says the Nuvia license isn't transferable, that removes the heaviest overhang on the stock.
You'd probably see capital flood back in because those 97% margins would be secure.
But an adverse ruling means Wall Street has to completely tear up and rewrite their 10-year valuation models.
We also need to keep an eye out for concrete AI CPU design wins, right? Like announcements from major players.
Yeah, every time a hyperscaler like AWS with their Graviton chips or Microsoft with Cobalt confirms they are expanding with ARM architecture, it validates the whole bull thesis.
They need those public commitments to justify the price. So I want to ask you, the listener, to think about what might already be priced in.
That's the hardest question in investing.
It is. When you see a 40% drop, it's easy to view it as a discount. But did that drop actually price in the risk of losing to Qualcomm? Or did it just wipe out the retail euphoria that had pushed the PE over 400 earlier this year?
A 278 multiple strongly suggests the market still expects near perfection. The trapdoor could still be fully operational.
Exactly. The easy money on the initial AI narrative is probably gone. The next big move in either direction is going to be dictated by legal outcomes and actual enterprise monetization.
Neither of which are guaranteed.
This whole analysis really highlights why a great business isn't automatically a safe stock. ARM is a masterclass in IP monetization. They've built an incredible moat. But balancing that fundamental growth against the mathematical reality of a 278 PE ratio while juggling litigation and insider selling, that's what separates reactive traders from critical thinkers.
You really have to evaluate the price of admission.
Absolutely. And that leads to a final, broader thought I want to leave you with. We just spent this time unpacking how fiercely ARM is fighting in court to protect its massive margins from customers like Qualcomm.
Right.
But if the company providing the foundational architecture, the bedrock blueprints of AI, is facing this much legal and economic pushback over its fees. What does that mean for the ecosystem as a whole?
That's a great question.
The tech giants are spending billions on these servers. If the cost of the raw IP is this highly contested, are the long-term profit margins of the broader AI revolution really as impenetrable as the market thinks?
It definitely suggests that margin compression in the AI space might just be getting started.
Something to mull over the next time you see a tech giant announce another multi-billion-dollar data center. Anyway, that wraps up today's Market Pulse Daily Analysis. Don't forget to subscribe, and be sure to check out that 14-day StockOracle trial link down in the description. Thanks for tuning in. We'll catch you on the next one.